The market is debating whether it was a quantitative easing that has commenced with this latest Fed's intervention of increasing balance sheets of banks. But is that for real? We can study many cases of whether it's quantitative easing or not. But the one thing is for real is that market right now is in a turmoil. So the position and also the situation of banks in United States and Europe may be under a stress, and that's the one thing that we'll discover today. As always, the most important news on the economy on Blockrevision Live. So I'm very glad to host you today. Without any further ado, let's head on. Alright, and the first block of today's Blockrevision transmission is regarding this chart that has shocked the market recently. As we can find, Federal Reserve System total assets has surged, and not much time of after we've seen many markets to rebound with a vengeance after this recent slump caused by this banking sector turmoil. So right now, as we do find, that's the one of the element that the market's intervention has been inflicted, and whether it's a quantitative easing that we also have been going through during this post-pandemic months. Right today, we have a much more complicated issue, as those are the elements that influencing just the balances of smaller banks. So just look at this. That's right here is what we can find, that market is in a respectively stable place when the biggest banks don't have the problems with liquidity, whereas those of smaller or medium sizes of balance sheets has possibly dark clouds above. So as we are right now dealing with such a high interest rate point at around 5%, those banks that have problems with lending money, we can find it might be going through a bumpy road ahead. So right here we can find that liquidity side, in terms of deterioration of reverse repo conditions, is the one that may possibly ignite a falling domino effect within next weeks to come. And by that terms, that might be a reason to complete the quantitative tightening. But the Fed already said once in right after this interest rate hike cycle has begun. So many may suffer, but the strongest will endure. And that's the thing, we may stick around in order to path that way ahead of us. So I don't find any reason of why Fed should end up this quantitative tightening and consider possibly ending up a this hiking cycle as of yet. So that's the thing you need to ponder, and don't really fall for that stupid narration that quantitative easing has started. Yes, so we have problems with banking system. That's why gold and also Bitcoin is rising. But those are the facts that are favoring the alternatives to current regulated banking system, and those two assets are the one of the two that are most prone to gain during that shaky environment. All right, so Fed meeting that's planned to take place on Wednesday, and will be also the insight in how they are tackling with this inflation that is sticking around. So recently we've seen that inflation takes root in services. Discretionary inflation even accelerated slightly in February, while month-of-month inflation in non-residential services was the highest since October. So in my view, in order to make the Fed hike interest rates by 0.5, this inflation gauges should increase worsen the outlook even further. But for now, CPI is dropping. Yes, so PCEs maybe has slowed down the falling pace, but still there is nothing to worry about for Fed. And this recent ECB's European banks, central banks decision on interest rates also finding a reverberation of what we may expect from Fed. And this latest inflation, even though it's hard to tackle, shouldn't be a dire fact for a Fed to pull over out of the trajectory of hiking rates. There is also one thing that Fed will need to take consideration at. So when throwing light at regional activity and the ISMs, we can find that this outlook is deteriorating. So we can find that it means that this inflationary pressure may fall due to this ISMs of United States. But it also means that the economy is getting weaker and weaker, and that's one of the important leading indicators that also should bother the Fed in the weeks to come. So we've already talked about it, that leading indicators are expecting the much more bigger headwinds for US economy, whereas this lagging one right now are not. So it means during the next quarters, maybe 2 quarters to come, we don't find much of a reason why Fed should take a path out of the one they have already indicated, but sticking around to this blindside rhetoric where we don't find any signs of recession is, for me, just stupid. That's why the Fed should take care of what might be underneath this underneath that rosy lagging indicators, and just look look a bit deeper and filter down all the data. In terms of next meeting, this is one to be delivered on Wednesday. We do expect rather 25 basis points rather than 50, as this after SVB's gone bankrupt, the Fed need to be more cautious in terms of their possible acceleration of this hiking narration, and that's why the market should stay in the similar range as we are as we are moving inside. So the market doesn't expect the turmoil. We do expect 25 basis points, and that's with a high possibility of being get delivered. So for this one, let me find out the Fed probability rate, and I'll get you to switch over the windows. So Fed probability rate right now is at 73.1% at 475 to 500. As yes, and yes, what it looks like. All right, so it's about the doomsday. That maybe not may not be that bad for the overall outlook, but that's the one of a doomsday for those that were betting for a full quantitative easing, as we don't expect this one to come over anytime soon. All right, so in terms of market outlook, let's head on to major indexes, and at first let's find out what's going on SPX. So today we are delivering transmission a bit later in time, but as I have mentioned right after market open, I find that the SPX trajectory should get us to this shelf at 3900s, and that's where I expect a possible accumulation phase at 0.5 Fibonacci extension. So it means that right now this trend is relatively resilient, and after Fed's meeting, I do expect the SPX to rally even forward, unless any other bank will fall into bigger trouble that may even worsen the sentiment around the markets one more time. So in terms of sentiment around the market, maybe we'll sorry, I haven't switched the windows. So in terms of SPX, once again, we can find that we are right now within this possible accumulation mode, and after taking over this 39.600 level, I do expect this trajectory to fill out, and next possible objective will be right at 40.2 hundredths. So that's about SPX, and right here, let me find out what's the sentiment around this markets. So right here we can find that we have recently has advanced from extreme fear to fear, and that's one of the two areas of a sentiment where those entrances to the market usually bring in the best outcomes of trading in a short medium term. So it means that when we are escaping this zone of a fear, there will be naturally coming over the neutral grid or extreme grid if this correction eventually accomplish. So that's about major the most important index right now. Let's head on to 1 second. I need to switch my windows. All right, so let's head on to market movers, and inside of this block of informations, we can find that this calendar is quite important in terms of the amount of events that we need to take care of in terms of avoiding a outstanding volatility. So on Monday we have had already a PPIs from Germany that was better than forecast. That's why we have let's just look at chart. That's why we have rebounded out of this recent area of a slide, and that's a possible form of a double top formation. That's why, in my view, German DAX should be the one of the fine to short right from that point. So that's one of the elements we need to take care of. But on the 4-hour chart, we have formed such of a candle that might be one of the point of a reversal, especially after we have just dived into another congestion zone that should gives us a support. So for German 40 right here, this double top might be the one that may get us a correction into a correction, but on a longer standpoint, I do expect this correction to persist for longer. So German 40, that's it right now. Let's get, sorry, I haven't switched once again this slide. So German 40 was the one I've been discussed over, and what we can find right here was this double top formation I have discussed about. It should correct us a bit to this level of 14.78, and right after the next stop should get us right at somewhere of 15.23. That's everything after reaching this congestion zone. So we have slided by 3.66% during recent 2 market sessions. Okay, so what we got there next? So the next will be earnings calendar. And on earnings calendar on Friday we had this expanded surprise to the downside, whereas on Monday we have a PDD Holdings and Egon and V, and on Tuesday we have Nike. That's very important for all of the value investors, and on Wednesday Chewy, and Woodside Energy Group Limited. So that's out of the most important brands that are about to report the data yet. All right, in terms of trade idea, so what I find to become interesting in terms of time to come. So for me, WTI USD is still in this slide mode. So we have right here has formed a possible reversal that right now get us to level of 66.92, and right after this slide we're gonna find that we are building a power for another rebound that may stop right at 67 bucks. If we manage to get to this area, I will find that that will be a very great point to have a short position, and the one of the position that will be against WTI. So in my view, after this correction, we might get once ahead to 64.45, and WTI may even slide further, as we have another horizontal important horizontal line at 61.88 around, as it's the horizontal zone right there. That's why you may even drag that position for few other sessions. So WTI, in my view, is to test that previous head and shoulders formation, this neckline of head and shoulders formation, and if we manage to get right here on a decent accelerating speed, that would mean that there is an exhaustion seen on the market, and the sell-off might be imminent. So for this one, we can find that this head and shoulders formation objection has already fulfilled. Yes, so that's why we right now are building a power for rebound, and the price trajectory should send us somewhere around 66.92. In terms of US 100, right here we also are forming a possible floor for the price, but with this spinning bottom that might be kind of powerful, but still we are in a territory where it's kind of a dangerous to bet against. And that's why WTI should be the one that should get us to lower valuations, whereas this US 100 is much difficult to bet against. All right, so yes, that's the WTI in a zoomed in zone. All right, so that's it in today's episode. Thank you very much for watching, and see you on Tuesday. I'm very glad you decided to pop in, and if you have any questions, just pop in a comment question below the video. So that's it, and